P11D's, and ERS returns. And I will briefly summarize each in the following slides. So a PSA arrangement. As an employer, you may provide some expenses or benefits to employees that are essentially a reward or a thank you, but actually these actually incur tax charges for the employee. So things like, staff entertaining, if you were going to take your employees out for a drink on a Friday evening, if you were going to provide a voucher to an employee for their good work performance during the month, even things like team lunches, working lunches where only staff are included. All these are actually taxable and reportable to HMRC. Now, HMRC recognise that in these situations, the employer may want to settle the tax due by the employee. As you can imagine, if we went out for drinks on a Friday night and then Chris turned around to me on Monday and said, well, actually, Preet, all those drinks I bought you on Friday, well, you actually have to pay tax on that. I don't think many of us will be very happy. So,
To be fair, please, I wouldn't have bought anybody a drink, so I wouldn't. That's not going to happen.
yeah, so that in that situation, HMRC allows for a PSA agreement where the employer can actually cover the tax and NIC due on behalf of an employee. So an application needs to be made to HMRC, and once this agreement is in place, it will continue until either you or HMRC cancels it or you need to change it. PSA reporting can be complex and time-consuming. It involves an analysis of data compiled from multiple sources. So, for example, if you are reporting staff entertaining, managers might incur the expenditure on their company credit cards. If there's a central event where everyone's invited to, for example, a company-wide Christmas party, central purchasing might take care of the costs related to that. So there's various bits of data that you need to compile together from various bits of the business. And therefore, it's a bit of a complex process. So it's important that businesses consider the wider picture and identify all the relevant expenditure that has been incurred. At Crow, many of our clients ask us to help them with their PSA process because we have the deep knowledge of the legislation and the release available. You have specific reliefs such as the annual event exemption and the trivial benefits exemption, and there are various exemptions related to long service awards. However, as with anything, HMRC do require certain conditions to be met to achieve those reliefs. So we hope that businesses understand those conditions before they apply them in the PSA process. The deadlines then, so to set up a PSA, you've got until the 6th of July at the end of following the end of the tax year. You have until the 31st of July to submit the calculations to HMRC, and then you have until the 22nd of October to pay the tax and the Class 1B national insurance that's due. Next, we have employer share plan reporting. So if any employers have any employee share schemes or allow employees to acquire shares in the company, then certain events related to these purchases or options need to be reported to HMRC through an annual ERS return. If there were no events that took place, HMRC also requires nil returns to be submitted as well. So what HMRC use these annual share plan returns for? Well, they can check various things in regards to the company. Firstly, they will make sure that the correct tax and national insurance has been operated on the share awards. They will also check any corporation tax relief claimed in relation to the employee share acquisitions, ties back to the returns. And they will also check individuals' employees' self-assessment returns compared to the ERS returns that companies submit. Therefore, employers should ensure that the ERS returns that they submit are complete correct and consistent with their payroll and corporate tax compliance positions. Automatic late return penalties apply, and you can also receive penalties of up to £5,000 for any inaccuracies within the return, which are due to carelessness or not corrected without delay. There are also implications when it comes to international mobile employees. So, for example, if you do have employees that travel around the world, they might be resident in various jurisdictions. It's important to understand the requirements in regards to share plan reporting in their cases, because certain jurisdiction rules don't necessarily align with the UK's. So employers need to think about those individuals and how to address those potential issues. Again, 6th of July is a key deadline date for all employer returns. So if you need to register any new share plans with HMRC, this needs to be done by the 6th of July, and also the submission needs to be made before the 6th of July. Okay, next, P11D reporting. This is probably the most common return that you might have heard of if you receive any kind of benefits from your employer, such as private medical insurance, company cars, beneficial loans. These are all taxable and reportable to HMRC. A P11D needs to be submitted for every employee who receives a benefit, and the return is due to HMRC by the 6th of July, again, following the tax year end. The Class 1A national insurance, which is the employer's obligation, needs to be paid to HMRC by the 22nd of July. However, the tax, which needs to be paid by the employee, is paid through a tax code adjustment. Now, the way in which this works is once the form P11D is being submitted to HMRC, it takes a couple months for HMRC to process the form. But once they have determined how much tax is due to be paid by the employee, what they do is they send a notification to the employee's payroll team. And that notification tells the payroll team how much personal allowance is available for the employee for the upcoming year. And the personal allowance is adjusted according to the tax that needs to be paid on the benefits that they received in the previous year. So, for example, if they had a company car with a taxable value of around 6K, and say the personal allowance was 12K for the year, the personal allowance will be adjusted so that it would only leave 6K as a personal allowance for the employee. So there's a lag between the employee receiving the benefit to when tax is actually collected by HMRC. And that's an important point that I want to bring out because of the next slide, which is that it was announced in the autumn budget that the P11D process is going to be stopped from April 2026. Apart from benefits such as accommodation and beneficial loans, all other benefits will need to be reported through the payroll on a real-time basis to HMRC. So P11Ds are going to stop for the majority of benefits, and now any benefits being received, be it a company car or a private medical benefit, that now needs to be reported through the payroll system. That means that employees will now be paying tax as soon as they receive the benefit, rather than having that lag between the previous tax year. This obviously brings some challenges for employers, especially where multiple benefits are provided to employees. So just say if you do receive private medical benefit and a company car, while there are two different providers there, potentially Bupa and potentially a company car leasing company. So you need to think about, employers need to think about, how is that data flow going to work? How are they going to get their information on a real-time basis rather than waiting till the end of the tax year to receive that information, because it needs to be processed through payroll on a monthly basis. So thinking about conversations with, your benefit providers, do they understand the new requirements, is something to think about for employers. Updating software. So if you do process your payroll in-house, there may be some software updates that you need to make so that you can start payrolling benefits if you don't already. So thinking about what you need to do in that area. Employee communications, this is a big one because as I mentioned before, employees where they receive a P11D are used to paying the tax through the tax code adjustment, which is, as I said, that kind of a year lag. However, they're going to now be paying the tax on a real-time basis. So if they're paid monthly, tax will be deducted on a monthly basis. Now, thinking about that first year of transition from April 2026, there's going to be a period where they're going to be paying the tax from the previous year's benefits that they received, but they're also going to be paying tax for the benefits that they're receiving in the current moment. So there's potentially a double tax that they're going to be suffering during that initial transition period. We're still waiting on HMRC information. They've only just confirmed that they're going to be payrolling benefits, or that's going to become mandatory. But we're still waiting more detail in regards to how that process is going to work, and maybe they'll give some more information in regards to that transition and that potential double tax that employees are going to suffer. However, this is something that employers need to think about, and I suppose it's the employer's obligation to inform employees that this may happen in the future. But we are keeping our ears close to the ground, so uh, we will be listening to HMRC and kind of spreading the news as soon as we get it. Also, training. So employees may need training if they've never payroll benefits previously. We need to think about any training requirements and thinking about doing this before the actual deadline hits is key to make sure you iron out any kind of teething issues. Okay, so the way that Crow are supporting businesses, we are holding training workshops for process stakeholders such as payroll teams and finance departments to let them know about the changes and what they need to think about. It's also a chance for businesses to review their current procedures and processes that they have in place. They can also look at their EVP, which is their employee value proposition, determine whether any benefits that they're providing are being taken up or whether it's worth kind of cancelling them and revisiting other benefits that they might provide. So it's a good opportunity for employers to review that. Obviously, the transition to mandatory payrolling benefits, we talked about the data flow. So, employers have to go out to their benefit providers, making sure that they understand their new requirements. What is the process going to look like going forward? How are they going to receive that data? Is that data going to be in a format that can be uploaded into the payroll system? Is that going to be easy? Does it need to be changed in any way? So there's a lot to think about around that. And then succession planning, which is basically documented the process so that you don't have any key person dependencies. There's so many instances that I've had to help out clients where they don't document their processes and procedures, and key people leave the business, and all sorts of errors take place, which end up with voluntary disclosures to HMRC and kind of tax liabilities and interest payments and all sorts. So succession planning is always key for businesses. Okay, and then the last slide is around compliance. So again, it was announced in the budget that 5,000 compliance officers are going to be hired by HMRC, and this is to bridge the tax gap, which is the difference between the government, what the government expects to receive in tax receipts compared to what it actually does receive. HMRC have determined that at least 30% of the tax gap relates to businesses not taking reasonable care when determining the amount of tax that needs to be paid to HMRC. Therefore, HMRC officers will be coming out to businesses within the next few years and conducting more employer compliance reviews to make sure that businesses are complying with the rules. These will include processes around national minimum wage, IR35 and the off-payroll working rules. expenses and benefits, and also end of year reporting. So it's key that businesses make sure that their processes are up to date. Again, Crow are supporting businesses with this. One of the engagements that I have is where I'm mirroring a HMRC inspector, and I'm going into a business. I've got the questionnaire which HMRC uses for the employer compliance reviews, and I will basically go through the whole process with the business, um, highlighting key areas of risk, and also producing reports determining how they can mitigate those risks with any adjustments to their processes or documenting procedures. And I think that's it. Yeah, that's it for me. Happy to take any questions, if any.
Thank you very much. I'll just stop that.
Some to put on note, really. One to do with the change in audit regulations, and also just to put a bit on note for future around change in accounting standards. I'm an accountant, so I get thoroughly excited by this kind of thing. So the audit regulations, just for those who need to sort of are on the cusp of it, are if you are a business that has a turnover of 10.2 million, gross assets of 5.1. Gross assets means fixed assets and current assets. So that's effectively the top half of your balance sheet. And you've got greater than 50 employees. So if you breach 2 out of the 3 of those for 2 years running, you need a statutory audit. Okay. There are complications around groups and stuff, which I won't go into, but broadly, if you breach those 2, then you need a statutory audit. So what's happening is, for accounting periods beginning on or after the 6th of April 2025, what they tend to do with these things is they make the accounting periods, it takes a while to understand what that applies to. So in theory, that would be a May 26 year end onwards, because it's the 6th of April 2025. So if you just had a year end, so obviously if it's the 1st of April 2025, then it would be a 30th of April 26 year end. So the new rules are that if the turnover limit has gone up from 10.2 million to 15 million, the gross assets has gone up from 5.1 million to 7.5 million, and the employees stay the same. So again, you have to breach 2 out of the 3 for 2 years running. But effectively, what you're going to have is people going effectively falling out of audit scope, which actually is, some might say, it's quite useful. Actually, so there's going to be quite a few businesses that need to sort of understand actually over the next year or 2 whether they're going to fall out of audit scope. So that's something just to be really sort of mindful of. I'll obviously send through an email to you, Suzanne, following this, that you can share and stuff. So just to sort of put that on notice. So just, I suppose the added bit to that is, if you've got external stakeholders in the business that are used to having a statutory audit, that's somebody that you need to manage. If you've got debt providers who are used to a statutory audit, there may well be a covenant relating to having a statutory audit. There may not be, but that's something, again, that you need to manage. There is something that a lot of accountants do provide, us being one of them, where effectively you can go halfway to what's called an assurance review. So what that does is a different, it's not just preparing a set of accounts for you, but it's not as much work as a full-blown statutory audit. And there's somewhere halfway between. So I think we're going to get quite a few businesses who think, actually, who are used to having an audit, they don't just want us not to check stuff. They actually just want us to sort of go to that halfway house and look at an insurance review. So I can send details about what that covers as well, for people's benefit. So that's quite an interesting, as interesting can be in audit world, in the next 18 months, 2 years. The other bit I just want to touch on is the change of accounting standards. I mean, it's like a bus, isn't it? You wait for it, and then it happens all, again and again. So we've got a couple of change of accounting standards coming up. So these are for periods beginning 1st of January 2026. Okay, so this is for December 2026 year ends. One fairly big change, one that could be a big change, which may or may not apply to people on the call. So the big change is around leases. Okay, so if you've got a normal operating lease, rent, let's just take rent because that's easy. You don't own the building, you've got an operating lease, you pay £200,000 a year. That operating lease just goes through the P&L as a cost. What's now going to happen is that we're following international accounting standards. So effectively, you have to do a calculation which creates an asset. So say if you've got a 5-year lease, you have to create an asset. You then create a liability. And then instead of the P&L charge being in rent, the P&L charge comes through as interest. Okay. So that's quite interesting, is that if you've got a number of leases, leasehold properties, there is actually a de minimis. So if you've got a photocopier and stuff like that, then you don't have to worry about that kind of thing. But if you've got some significant sort of leases, then actually this could completely change what your balance sheet looks like and what your P&L looks like. That is there could be a very significant change. What I would say as well, just added on to that, if you think if you've got funding, if you've got debt providers, your liabilities has just shot up, which a lot of people, a lot of debt providers are interested in your net debt calculation, so to speak. You may have covenants within that debt provider, so it could work both ways. Effectively, your EBITDA, what we call earnings before interest, tax, and depreciation, will actually go up because your rental charge has been replaced with interest. But then you might have a covenant based on interest cover, where actually your interest charge in the P&L is significantly higher than what it was. So I think there's going to be a period over the next 12 months or so that there's an education needed for a lot of our clients, and maybe you guys want us to have a look at that too, to understand what the potential effect of that business, those changes are. In particular, around if you are renewing a facility, a banking facility, for example, which actually means that halfway through that facility period, there's a change in accounting standards, which actually might mean that you breach covenants, potentially. Could be as well from a transaction perspective. Our corporate finance guys here know that this is on the cards. If deals are based on earnouts, what's that earnout figure look like? What's it based on? What's in the control of the sellers post-deal, and things like that. So there may well be things that need to be written into SPAs to take account of this change of accounting standard. So just so you know, this is IFRS. So actually, there's a lot of the big businesses who use IFRS anyway will know this has been in play for the last at least, greater than 5 years. But for the smaller businesses that use UK GAAP, this is a big change. So just a word of warning, and I don't want to put everybody in this category in the same boat, but most debt providers that I've spoken to have no idea that this is coming around the corner. So bank managers, debt providers, anything like that. They haven't got a clue. So there's an education needed on that front, and we may want to take that offline, Suzanne, because I think we need to do something for that. But yeah, so that's something that needs to be managed. The other one, change of accounting standards, I'm conscious of time, is around how you recognize revenue. I won't go into this ridiculously too much, but if you are a business that has, in particular, long-term contracts, and you have you recognize revenue over a period of time rather than you sell a widget and it dispatched and you recognize revenue when that widget leaves the door, then actually there is a change in how you measure that, which could be quite significant if you do long-term contract accounting. So remember, long-term contract accounting is basically meaning that if there's any revenue that spans a year end, so that could only be 2 months, but if it spans the year end, then that's defined as a long-term contract. So just, I won't labor too much on that. If you know of anybody or are a business that you think could be affected by that, there is a big piece of work that needs to be done on that in preparation. So there's two fairly fundamental sort of changes in accounting. As we go down this, there needs to, as I said, there needs to be some education done over the next few months, and in 2025, we can do a bigger session on that, obviously with examples with from a governance perspective and how that could, we could create some covenants and show you how it could be breached or not. We'll get our corporate finance guys to think about sort of deals that are happening or just about to happen and how actually the account change of the leases could affect it. So I think there's a bigger piece to do on that over the next few months, which we can maybe do an in-person event on that within this finance focus. But they're big things. So with 3 minutes to go, hopefully no questions. But take offline if you want.